we will focus on the Global Reporting Initiative framework. This is to report the enterprise's sustainability activities and action to stakeholders. The Australian Sustainability Index was launched in 2005 to provide a comprehensive assessment of enterprises' economic, environmental, and social performance. That's one of the indices that was provided for reporting purposes. The second was the Aussie Index was made available to the public so that consumers and investors can evaluate enterprise performance. But for reporting purposes, the Global Reporting Initiative is widely used to show enterprises' commitment and serve as a benchmark for comparison with other enterprises. It has several aspects in that reporting. The foundation in that framework is the starting point of the reporting. The first aspect is the general disclosures, which start with Series 100. It reports on enterprises' contextual information. The second is the management approach. Again, it's a 100 item. Reports on the management approach for each material topics on sustainability. There are 3 material topics: economic, environmental, and social. And then the 200 series and 300 series and 400 series items are about reporting on economic, environmental, and social. The framework has a number of items, but the enterprises would choose relevant items from this framework for reporting purposes on economic, environmental, and social aspects for performance. Economic performance measurements. That's the 200 level items. There are 3 aspects in it. Is the economic, that's the financial implications and the risk and opportunities from engaging in sustainability. Then the market presence, that is the policy and practices and the proportion of spending on sustainability. Third is the indirect economic impact. It's about the development and impact on infrastructure investment and services provided primarily for public benefit. The environmental performance measurement, which is the 300 level items, have 5 aspects. Materials, it's reporting about the percentage of materials used that are recycled input materials. Then about energy, the direct energy consumptions by primary energy source. Third is about water, percentage and total water that is recycled and reused. Is about biodiversity. It's describing the significant impact on activities, products, and services on biodiversity in protected areas and areas of high biodiversity value. Fifth, the next one is emissions, the total weight of waste by type and disposal methods. Now, all these items may not be relevant to a given enterprise, so they will pick and choose items relevant to them. Social performance measures are the 400 items. There are 6. They are employment, labor and management relation, occupational health and safety, diversity and equal opportunity, about child labor, and about forced and compulsory labor, whether the enterprise use them or the enterprise return something to address these issues. The next is the social performance measures. They are the 400 items. It's about the rights of indigenous people, local communities, marketing and labeling, and customer privacy. So the GRI principles to define reporting quality and assess performance. The reporting has to be accurate and detailed, has to be balanced with positive and negative information, has to be clear, it should be meaningful and understandable, should be comparable over time with the same firm and with other firms, should be reliable through reviews, and should report material items, and should be timely so that stakeholders can make timely decisions. Sustainability also requires attention on its management. There are 5 aspects to manage sustainability: environmental management system, environmental management accounting, life cycle analysis and costing, capital budgeting, activity-based costing, and balanced scorecard. Environmental management system is the first one. It is to manage its environmental impact effectively. An organization must engage in necessary management activities of planning, control, and evaluation. Various standards exist to identify and benchmark key aspects of environmental performance. For example, the International Standards for Environmental Management Systems, ISO 14001, ISO 14004 are used by many enterprises in Australia and around the world. Here's a graphic of BlueScope State's environmental management system. It highlights the importance of translating the broad values of the enterprise into specific implications for day-to-day operations. So it starts with the policies and procedures, and these policies and procedures are then cascaded into codes of practice and guidelines, then into standards, then into principles, then policies, and their purpose of doing it. Second is the environmental management accounting. In environmental management accounting, it supplements the cost of accounting system by providing information about environmental impact on organizational activities. There are specific tools to include life cycle costings, which is similar to life cycle analysis, but with a focus on measurable costs and full cost accounting. There are various ways in which and environmental objectives can be incorporated into cost management, such as activity-based costing that separate out the environmental costs. Although more than 30% of enterprises' resources are wasted, their cost is included in the product or service cost. Effectively hiding the waste and leads to incorrect pricing. So we can, through activity-based costing, we can separate out the waste and identify the actual cost rather than including them in the cost of the product. The solution is to provide separate account for waste that includes the cost of removal and cost incurred in acquiring resources in the first place. When we identify the waste, cost of waste separately, then we can look at that cost as a separate item and to find out how we can decrease the cost of waste. There are various ways in which environmental objectives can be included in cost management. One is life cycle analysis and costing. In life cycle analysis, it evaluates the product or service over its life and focuses on the financial costs incurred. Life cycle analysis begins to recognize some of the social and environmental impacts that can't be costed, such as amount of carbon dioxide associated with every stage of product's production and use. The move to life cycle analysis is seen as a way of broadening the focus from value generating for a limited use of stakeholders to recognize the cost through the product or service life cycle. In many cases, it is impossible or inappropriate to put a dollar amount on the costs imposed. So the life cycle analysis may focus on other measures, for example, quantity of toxic emissions. Third is capital budgeting. There are various ways in which environmental objectives can be included in cost management. One is to change over to reusable shopping containers or shopping bags to create cost savings for the enterprise and its customers. The cost savings to customers can provide the basis for negotiating a higher price. Some important aspects not easily quantified, for example, competitive advantage of reusable shopping containers in terms of employee safety. Risk is also an important factor in this capital investment decisions. For example, reusable steel shopping containers for transporting toxic materials may reduce the risk of a spill with its associated fines and impact on reputation. Fourth, the balanced scorecard. There are various ways in which environmental objectives can be included. Management accounting tools can be adapted to pursue social and environmental objectives. The balanced scorecard methodology can be used as a map to manage interrelationship between the drivers of social, environmental, and economic performance. Fifth is to justify the environmental performance economically is to recognize that all potential cash flows effects associated with the enterprise's environmental impact is impossible, but it increases the awareness, and that's important. Share price for a listed company is determined by anticipated cash flows and the risk associated with these cash flows. Enterprises have an incentive to demonstrate the market that they have effective systems in place to manage their environmental performance. The Pareto Principle, which is 20% of production and activities to 80% of environmental costs, is another approach where the quality management approach. In this, the costs are categorized and can be applied to environmental impact management to for prevention, appraisal, internal failure, and external failure. There are various strategies available for sustainability. The enterprise strategy requires a change in culture that must be infused throughout the enterprise. Learning for sustainability is to describe the ongoing learning that must occur within an enterprise to pursue on sustainability. Total quality management equally applies to sustainability in that journey, not as a destination, but as an ongoing process. Total quality management, the objective of sustainability are unlikely to be completely met. Rather, they provide the goal continuity to strive towards and emphasize on the rate of change. The planning tools could be used for strategic environmental assessments, environmental impact assessments, sustainable impact assessments, risk assessments, and cost-benefit assessments. And environmental impacts of operations could be used for managing standards of using standards like ISO 14000 series and total quality environmental management. Common product and process design tools, environmental design and life cycle assessment, and monitoring and evaluation tools, effects on compliance monitoring, site, energy waste, health and safety audits to conduct and benchmark for performance. The social performance measurements under the GRI framework covers employment, labor and management relations, occupational health and safety, diversity and equal opportunity, child labor, forced and compulsory labor. It also covers rights of indigenous people, local communities, marketing and labeling, and customer privacy. The GRI principles for defining reporting quality to assess performance comprise of 6 attributes. It has to be accurate and detailed, balanced with positive and negative information, meaningful and understandable, comparable over time with the enterprise and with other enterprises, reliable in terms of the information has been reviewed and material, and it's available on a timely manner for stakeholders to make decisions.